Getting into cryptocurrency can be incredibly exciting, but it's also where most beginners lose money. Not because crypto is a scam, but because they make avoidable mistakes driven by emotion, hype, and lack of knowledge. In this video, I'm going to walk you through the 5 biggest mistakes beginners make when entering the crypto space and, more importantly, exactly how to avoid them. If you're new to crypto or thinking about getting started, this could save you thousands of dollars and a lot of regret. Let's dive in. Mistake number 1 is investing money you can't afford to lose. This sounds obvious, but you'd be shocked how many people violate this rule. They see Bitcoin up 50% in a month. They hear stories of people getting rich from Dogecoin or Shiba Inu. They feel like they're missing out on life-changing money, so they take money meant for rent, for emergencies, for their kids' education, and they dump it into crypto, hoping to get rich quick. Then the market crashes, which it always does eventually, and they're financially devastated. Here's the hard truth. Cryptocurrency is extremely volatile. Bitcoin has dropped 50% or more multiple times in its history. Altcoins regularly lose 70, 80, 90% of their value in bear markets. If losing your investment would ruin your life, harm your family, or prevent you from paying bills, you absolutely should not invest that money in crypto. Only invest what you're prepared to lose completely. Treat it like high-risk speculation, not a guaranteed return. A good rule of thumb is that crypto should be a small percentage of your overall portfolio, maybe 5 to 15% depending on your risk tolerance. Never go all in. Mistake number 2 is buying at the peak during hype cycles. This is the classic beginner trap. Bitcoin hits a new all-time high, and suddenly it's all over the news. Your friends are talking about it. Social media is flooded with stories of people getting rich. Celebrities are endorsing it. You feel intense FOMO, fear of missing out, and you think you need to buy right now before it goes even higher. So you buy near the top. Then the market corrects, as it always does, and you're down 30, 40, 50%. Almost immediately. The psychology is brutal. When crypto is pumping and everyone is making money, that's actually the most dangerous time to buy. That's when risk is highest and future returns are lowest. The best time to buy is when nobody cares about crypto, when prices have crashed, when the media declares it dead, when your friends think you're crazy for even mentioning it. That's when assets are cheap and future upside is massive. But buying during fear requires discipline and patience that most beginners don't have. They do the opposite. They buy during greed and sell during fear, which is exactly backwards. If you're just getting started, don't try to time the market perfectly. Use dollar cost averaging instead. This means investing a fixed amount regularly, like $50 or $100 every week or month, regardless of price. Sometimes you'll buy high, sometimes you'll buy low. Over time, you average out the volatility and avoid the psychological trap of trying to catch the perfect entry point. It's boring, but it works much better than emotional decision-making. Mistake number 3 is falling for scams and rug pulls. The crypto space is absolutely filled with scammers targeting beginners. They promise guaranteed returns, insider information, secret strategies, or revolutionary new coins that will 100x. They create urgency, claiming you only have 24 hours to get in before it's too late. They use fake testimonials, doctored screenshots, and sophisticated social engineering. And beginners fall for it constantly because they lack experience recognizing red flags. Here are scams to watch out for. Giveaway scams where someone impersonates Elon Musk or another celebrity claiming to double any crypto you send them. It's fake. You'll never see your money again. Pump and dump schemes where groups coordinate to artificially inflate a low-cap coin, then dump it on unsuspecting buyers. Rug pulls where developers create a token, hype it heavily, then drain all the liquidity and disappear. Ponzi schemes promising absurdly high returns, like 1% daily, which is mathematically unsustainable. Fake exchanges or wallet apps designed to steal your cryptocurrency. Phishing websites that look identical to legitimate platforms but steal your login credentials. How do you protect yourself? Be extremely skeptical of anything that sounds too good to be true. Legitimate investments don't promise guaranteed returns or pressure you to act immediately. Never send cryptocurrency to anyone claiming they'll send back more. That's always a scam. Don't trust random people who message you on social media offering investment advice or opportunities. Research projects thoroughly before investing. Check if the team is public and has credible track records. Look for third-party audits of smart contracts. Verify websites carefully. Scammers create fake sites with URLs that are one letter different from the real thing. Use two-factor authentication and hardware wallets for security. Mistake number 4 is not securing your crypto properly. Beginners often leave their cryptocurrency on exchanges indefinitely, which is risky for multiple reasons. Exchanges can be hacked. Even major exchanges have lost customer funds to hackers. Exchanges can freeze your account or restrict withdrawals, especially during high volatility. Exchanges can go bankrupt. We saw this with FTX, Celsius, and others. Customers lost everything. If you don't control your private keys, you don't actually own your crypto. The exchange does. The saying in crypto is not your keys, not your coins. This means if you're holding cryptocurrency long-term, you should move it off the exchange into a wallet you control. For significant amounts, use a hardware wallet like Ledger or Trezor. These are physical devices that store your private keys offline, making them nearly impossible to hack remotely. For smaller amounts, reputable software wallets like Exodus or Trust Wallet work fine, though they're less secure than hardware wallets. Critically important, when you set up a wallet, you'll receive a recovery phrase, usually 12 or 24 words. This phrase is the master key to your cryptocurrency. Anyone with this phrase can access your funds. Write it down on paper and store it somewhere extremely safe. Never store it digitally. Never take a photo of it. Never share it with anyone. If you lose this phrase and something happens to your wallet, your crypto is gone forever. There's no customer service to call. No way to recover it. Thousands of Bitcoin are permanently lost because people didn't secure their recovery phrases properly. Mistake number 5 is overtrading and chasing pumps. Beginners often treat cryptocurrency like a casino. They buy a coin, watch it go up 5%, get excited, sell for a small profit, then jump into another coin, hoping to catch the next pump. They're constantly trading, constantly chasing momentum, constantly trying to outsmart the market. This almost never works. What actually happens is they rack up trading fees, they make emotional decisions, they buy high and sell low repeatedly, and they end up with less money than if they just bought and held. Successful crypto investing is usually boring. You research projects thoroughly, you buy quality assets at reasonable prices, you hold through volatility, you ignore short-term noise, you don't check prices every 5 minutes, you don't panic sell during corrections, you stay disciplined and patient. The people who made life-changing money in crypto are mostly those who bought early and held for years, not day traders who tried to time every little move. Trading is a skill that takes years to develop. Professional traders use sophisticated tools, algorithms, and strategies. They manage risk carefully. They have emotional discipline from experience. If you're a beginner with no trading background, you are competing against these professionals and you will lose. The house edge in crypto trading goes to those with more information, better tools, and greater experience. That's not you when you're starting out. If you do want to trade, start extremely small with money you're completely okay losing. Track every trade, learn from mistakes, study technical analysis, understand risk management. Accept that you'll probably lose money while learning. Most beginners would be far better off simply buying Bitcoin and Ethereum and holding long-term rather than trying to actively trade. Here's what to do instead of making these mistakes. 1. Only invest disposable income you can afford to lose. 2. Use dollar cost averaging rather than trying to time the market. 3. Research thoroughly and avoid anything promising guaranteed returns or creating artificial urgency. 4. Move significant holdings off exchanges into secure wallets and protect your recovery phrase. 5. Resist the urge to constantly trade and chase pumps. Buy quality projects and hold with patience. Cryptocurrency offers incredible opportunities, but it punishes mistakes brutally. There's no safety net, no insurance, no way to reverse transactions. You are entirely responsible for your own security and decisions. This is both empowering and terrifying. The good news is that if you educate yourself, manage risk properly, and avoid emotional decision-making, You can participate in this space successfully without losing money to avoidable mistakes. Every experienced crypto investor has made at least some of these mistakes. I certainly have. The key is learning from them without losing so much money that you give up entirely. Treat your first year in crypto as education. You're learning how markets work, how to manage emotions, how to evaluate projects, how to secure assets. Focus on not losing money before you focus on making money. Protection of capital is the foundation everything else builds on. If you found these warnings helpful, make sure to subscribe for more crypto guides. In the next video, I'll explain what a Bitcoin halving is, why it matters, and how it historically impacts price cycles. Thanks for watching, and I'll see you in the next one.